All right, I think we're ready to go here. So good morning, everyone. I hope you had your chance to get some coffee in you this morning as we delve into taxes. This is the fourth part of our five-part series on personal finance. So we've previously covered credit, budgeting, and insurance. You can find those videos on our website. And next Tuesday, we'll be having our fifth and final installment on investments. So stay tuned for that. And again, thank you for joining us. So before we start, some brief introductions. My name is Jake Erlinson. I'm a lead advisor with Dowling and Yahnke. Dowling and Yahnke is a registered investment advisor founded in 1991. We primarily serve individuals and families, as well as some local nonprofits that collectively have over $4 billion in assets that we manage, in addition to providing them with financial planning services. Joining us this morning is my colleague Hope Carlson, who you may recognize from her seminar on budgeting. So I'll turn it over to Hope to introduce herself. Oh, say good morning.
Good morning. Hi, everybody. Thanks for joining us, and thanks, Jake. I'm Hope, as Jake said. I'm also a lead advisor here, and I'll be the moderator today. When you send in your questions, I'll be taking a look at those, and if you would like us to be sure to get back to you in case we don't have time in today's session, please include your name and email address, because all questions come to us anonymously. But we will get to as many as we possibly can during the session today. In addition, if you happen to be watching the recording instead of joining us live and you have questions, please feel free to reach out to Jake or to me at the email addresses you see on the screen below our pictures. Thanks, Jake.
All right. Okay, well, every good tax seminar or tax advice comes with a good old disclaimer. So note that Hope and I are not accountants, we're not CPAs, but it is our job to be aware of and to be sharp when it comes to the tax laws and how it might affect our clients. Keep in mind that also the Internal Revenue Code is greater than 70,000 pages. So the topics and subjects we're going to cover today are only scratching the surface. We're really providing you with this information to generate some general awareness as a way to educate yourself going forward here. So here we go, making sense of taxes. As I mentioned before, our goal today is just to develop greater awareness as to the basics of how taxes work, how they may affect you, and how you can think about them moving forward. Here's our agenda for today. We'll probably jump around a little bit, so bear with us. And again, if you have any questions or something is unclear during the presentation, please jump in with your questions and we'll do the best we can to clarify or answer your question. So we'll start off today with a brief overview of taxes. Then we'll talk about income, what that is, how that's defined. Not all income is the same when it comes to taxes. We'll talk about the tax rates or your income taxes, how those are calculated and how that affects you. We'll then also talk about deductions and credits, which can help lower your taxes. So it's important to be aware of those opportunities when they arise. And lastly, we'll share some ideas with you on how you can save money on your taxes. And we'll conclude with a Q&A session for any questions that or topics we may have not covered during the presentation. All right, part one, the overview. So there are many types of taxes. You're probably aware of most that you're seeing on the screen. Today, we're going to focus mostly on federal income taxes, but it's important to recognize that throughout life, you're going to experience many different types of taxes. So we've listed out some that you're probably familiar with. Income tax, which obviously we're going to tackle that today, but also recognize that you have sales tax. So these are taxes on your goods and services that you are purchasing. You have property tax that's based on the value of your real estate. For folks that have large estates, they're subject to basically, if they have really large estates, currently this year the exemption amount is $11 million. So basically, any person with an estate that has over $11 million, if they're gifting or leaving that estate behind, that portion of the estate or gift that's greater than $11 million is subject to either gift or estate tax. We're not going to get a whole lot into that, but if you have more than $11 million, Hope and I definitely would like to follow up and talk with you after this presentation. A couple of kind of ancillary taxes, just kind of fun to mention. Your hotel tax. So anytime you stay somewhere, you know, that price that you see on Priceline or Hotels.com, usually the price is not as attractive as what you're seeing on the screen because of taxes. Then you also have the sin tax, which applies to the consumption of alcohol or tobacco or other things that we don't have to talk about today. And then you've got payroll tax, so Social Security and Medicare. So all these taxes are you know, they're designed to provide revenue to the state and federal government so that they can provide, you know, social programs and services that benefit our communities and our country. A quick aside, you know, we all, Hope and I, we live in California. I think many of you do. You know, California is a pretty expensive state to live in. It has a pretty high cost of living when it comes to income tax, sales tax, and property tax. And some people refer to this as the sunshine tax. Because why do we live here? It's a great place to live. The weather is wonderful. We've got access to lots of resources like the mountains in the wintertime to go skiing, but then we have access to the beaches and the coast throughout the year. So you may have heard of that before. That's what it is, the sunshine tax, the high cost of living that we get to enjoy as part of living in California. Okay, so moving on here, we want to share with you the basic income tax formula. And I would even say that this is a little bit more complex than it needs to be here. But basically, we are focused on your gross income. So we're going to talk about the income that you have. And then you have deductions that we talked about that can reduce your taxable income. So there's two types of deductions, and we'll get into that a little bit later. But you have deductions before your adjusted gross income and deductions after. And then once you get to your taxable income, that's where you do the math to calculate what your taxes are, and we'll cover that today. And then finally, you have tax credits, and those credits are a dollar for dollar reduction in the tax that you may owe when it comes time to do your taxes. One other thing to point out is that when you file your tax return, you have to claim your status. So generally speaking, most people are going to claim either a single status, meaning you're not married, or married filing jointly. But there are some other statuses that you can file your tax return under, married filing separately or head of household. We're not going to talk too much about those today, but in terms of the tax tables and the rates that we look at, these two, married filing separately and head of household, are very similar to the single tax brackets, but there are differences. So we just, again, want you to be aware that there are some differences when it comes to filing status. Okay, so now we're going to talk about income. I think this is pretty straightforward, but it's important to recognize that in general, there are two types of income. There's ordinary income, and then you have capital gains income. Keep in mind when we're talking about these two types of income that we're talking at the federal level, not the state level. California doesn't make a distinction between ordinary income or capital gains income. They tax all income the same. At the federal level, it's a little bit different, so we're going to explore that. Okay, so ordinary income, what is it? What could it be? Well, I think this is sort of obvious in that wages, salaries, tips, commissions, those types of things that you might earn from your job, those types of income are treated as ordinary income. But there's also other sources of ordinary income that you may experience now or later in your life, and those include interest payments, so that could be interest paid on your savings account, a CD, investments. You might one day have a rental property. If you have rental property, there are rents and you receive income through that channel. Royalties, so that could be from writing music, writing books, things like that. And then you have non-qualified dividends and short-term capital gains. Those are two different types of investment sources of income, and we'll talk a little bit about that. In general, what I'll say when we talk about investment income, we'll just refer to that income coming from a stock-like investment, but recognize that these types of income, non-qualified dividends or short-term capital gains, could be generated from other types of investments that you might have. So that's ordinary income. The next type of income is the capital gains income. And so on the previous slide, you saw that I referenced short-term capital gains. Here, I'm going to be talking about long-term capital gains income, and here's what that is. In general, a capital gain is going to be the current value of some investment that you purchased, less what you paid for it. It becomes a long-term capital gain when you've held that investment for longer than 1 year. If you've held the investment for less than a year and you sell it prior to passing a year's time, that capital gain is going to be considered a short-term capital gain, and it will be taxed as ordinary income. Long-term capital gains have to be held for at least a year to receive the special tax treatment that we'll share with you in a moment. And then lastly, just because you have a capital gain doesn't mean that you're going to be taxed on it. You're only taxed on the capital gain once you sell the investment, and that's what's called a realized long-term capital gain. So if you bought an investment and held it for a long period of time, you might have an unrealized capital gain, but once you sell that investment, it becomes a realized long-term capital gain. So let's maybe look at an example of capital gains here. So just to illustrate the concept. So let's imagine that you purchased a stock for $100. And over time, it goes up. And now it's worth $150. So to calculate your capital gain, it's pretty straightforward. You take the market value, the $150 that it's grown into, you subtract the $100, and you have a $50 capital gain. If the capital gain was incurred less than a year and you've sold the investment, you're going to be taxed at that short-term capital gains as ordinary income. Or if you hold it for longer than a year and then sell it, it'll be taxed as a long-term capital gain. Now I'll make a quick distinction here that there are different types of investment accounts, and when something becomes taxable, it's typically held in a brokerage account, which might be in your own name, or it might be in the name of a revocable living trust, something like that. That's when you would have taxes owed on a realized capital gain. If you had a realized capital gain that was held in an IRA account, a Roth IRA, or a 401k account, when you realize capital gains in those types of accounts, there's no taxes associated with those capital gains. Now, there's one other thing that I would like to share with you regarding capital gains and their income. What if you bought an investment for $100 and it went down in value, and now that it's worth only $50? Well, now you have what's called a capital loss, and you can sell that investment and recognize that loss. So here we have a capital loss of $50. That $50 loss could be used to offset that realized gain from this other investment that you purchased that went up $50. And at the end of the day, it would result in zero taxes because that $50 of capital gains income has been offset by that $50 of capital loss that you incurred. So that's something to be aware of when you start getting involved with investments and managing your taxes. All right, so now we're going to review how income taxes get calculated. So remember, there's two types of income. We're going to focus on the ordinary income first. and then we'll look at capital gain, long-term capital gains income and how that's taxed differently. So remember we talked about the filing status. So we're looking at in the second column here. Bear with me here, get my laser pointer working again. Okay, so the single column is for someone that's filing their taxes as a single filer, and the third column there is for someone filing their taxes under married filing jointly. You'll see that there's basically 7 tiers to the tax rates and the income. And basically each segment of income that you see in this table here is taxed at different rates. So not all of your income is necessarily taxed at the same tax rate. This is where taxes can get a little bit complicated. But the general gist of this is the more you make, the more they're going to take. So here we'll look at one other point that I'd like to highlight. You'll notice that if you're filing single versus married filing jointly, that for each of these brackets, the ranges are basically doubled for someone that's married filing jointly, except once you get to the upper brackets of 35% and 37%, it changes and you're no longer doubling those brackets. So again, the more you make, the more they're going to take. So we've highlighted that here. Okay, so again, I just want to point out that for these tax brackets that we looked at, that not all of your income is being taxed at one of those tax rates, but it's progressive. So in this example, for someone that's filing single, you can see that approximately almost $10,000 of income, ordinary income, is taxed at a rate of 10%. Then the next $30,000 of income to get to the top of the 12% bracket is $40,000. So this $30,000 of income is taxed at 12%, and it gradually increases for each segment of income. The more you make, the more they take. All right, so that was covering ordinary income. Now what I'd like to do is cover the long-term capital gains. So if we look at this chart off to the right, you'll see that there are only 3 tiers of tax rates. And that's because long-term capital gains are taxed differently than your ordinary income. But there's a relationship to the tax rates on your capital gains versus your ordinary income. So first to point out that if you only had long-term capital gains income and you were filing single, you could have $40,000 of long-term capital gains and your tax rate would be 0% on that money. If you had greater than $40,000 of capital gains, you're then jumping up into the 15% bracket. But not all of your money is being taxed at 15%. It's only going to be the portion that is greater than $40,000. So if we imagine someone had $50,000 of capital gains tax, or capital gains income rather, sorry, the first chunk of $40,000 would be taxed at a 0% rate, and the additional $10,000 to get them to their $50,000 total would be taxed at 15%. So effectively only $10,000 of long-term capital gains is being taxed at 15%. Now, how does this relate to the ordinary income tax brackets? Well, you might have a combination of ordinary income. You might have a combination of ordinary income and qualified dividends or long-term capital gains. So that's where things get a little bit complicated in these calculations. So what tax rate do you pay? Well, it depends. Your marginal tax rate is going to be associated with the tax brackets. So your marginal tax rate is basically, if you earned $1 additional, what would that dollar be taxed at? So if we looked here, and we looked at someone that made $40,125, if they made one more dollar, their marginal tax rate would shift from 12% to 22%. But then we also have what your average tax rate is. So let's take a look at that. Here's an example of someone with $50,000 of ordinary income. They're going to have a marginal tax rate of 22%. They've gone through the 10% bracket, they've gone through the 12% bracket, and they enter into the 22% bracket. Here we can see how that's calculated. So the first $9,800 of income or so is taxed at 10%, resulting in the $987.50 here, which is the tax associated with that bracket. We jump over to the 12% bracket, where there's approximately about 30,000 of income that's taxed at 12%, resulting in $3630. And then they've got a portion of about $10,000 that's taxed at 22%. So we're incrementally adding up those taxes to get the total tax owed, and we can use that number divided by the total taxable income to calculate the average tax rate. So that's the difference between your marginal tax rate and your average or your effective tax rate. The important thing to recognize with your marginal tax rate is that that is the tax that you're going to pay on the additional dollars that you earn on top of any existing income that you've made. So one might be tempted to ask, well, what if someone were to gift, say a parent or a grandparent, gift money to their grandchild or child who might be in a lower tax rate? And I would say that's a pretty good idea, except the IRS has already thought of that. And so they've come up with something that's referred to as the kiddie tax. And this basically, in general, applies to kids that are 17 or younger, or kids that are, or young adults, I should say, that are students whose earned income is less than 50% of their financial support. So in general, it might be someone who's being claimed on their parents' tax return. You know, the parents are getting maybe some tax benefits to putting their kids on their tax return. Well, the kids can't take advantage of their low tax rates. They're going to end up paying their parents' marginal tax rates as a result of the kiddie tax. So basically, when we're talking about unearned income, we're thinking of investment income. So that could be from stock, capital gains, it could be dividends, it could be rental properties, any types of investments that you have that are generating income and you're the owner, you might be subject to kiddie tax. Let's look at a real simple example of how this might work. So we've got John, he's 17 years old. His parents are in the 24% federal marginal tax bracket. His parents have given him some stock, and that stock has earned $3,000 in dividends this year. John also has a part-time job, and he's earned $2,500 waiting tables. So what is his kiddie tax? So again, we're looking at the net unearned income of $3,000, which is related to the dividends. And he has earned income from his job of $2,500. His $2,500 is not included in here. We're looking just at the unearned income that he got from the stock investment. So we have $3,000. The IRS allows John to take an exemption or a deduction on his $3,000 of $2,200. That leaves him with taxable income of $800 associated with his unearned income, and that $800 is going to be taxed at his parents' marginal tax rate, which we noted is 24%. So rather than John maybe paying that 10%, that lowest tax bracket that we looked at, he's going to pay 24% on that $800 of income, which means he's paying more taxes. All right, so now we're going to move on to deductions and credits. Deductions and credits are going to help you reduce your taxable income in the future. So again, just highlighting where this plays in our basic formula, we've got deductions before AGI and deductions after AGI. there's a slight benefit to deductions before AGI because AGI is used in some calculations when it comes to determining your taxes. So if you can lower your AGI, that could result in a greater amount of deductions. We'll look at that in just a bit. And then you have tax credits. So remember, tax credits are reducing your tax owed. They're not reducing your taxable income, but the actual tax that you would potentially owe. So here we've just summarized that. So they both are going to reduce your taxes. So deductions and credits, they're good things. The benefit to credits are that they reduce your tax dollar for dollar, whereas deductions are reducing your taxable income, which then results in tax. So let's take a look at some of these above the line deductions. So you have here contributions to an IRA account or a 401k account that you might have with your employer. You might have access to a health savings account, which is a special account that you can fund to pay for medical expenses now or later down the road. If you have student loan interest, you might be able to deduct up to $2,500 of your student loan interest. Again, there's some AGI limitations on that. So remember, these above the line deductions help reduce AGI, so that can be helpful. And then we've got, if you're a teacher, teachers can deduct up to $250 of classroom expenses. So the special thing about above the line deductions are they do not require you to itemize. So what does that mean, itemized deductions? Well, basically everyone gets a choice when they file their taxes. They can take what is called a standard deduction or an itemized deduction. A standard deduction is everyone is eligible for that. So if they're a single filer, they can claim a deduction of $12,400 in 2020. Or if they're married filing jointly, they can claim a deduction of $24,800. So why might someone want to itemize? Well, you might itemize if you have any of these things going on down below, and in total they add up to more than either $12,400 or $24,800. So for example, medical expenses. If you have a year where you incur a high amount of medical expenses, you have an opportunity to deduct some of those medical expenses. However, it's subject to an AGI limitation. So to explain that, imagine you had $100 or $100,000 of adjusted gross income. You would calculate 7.5% of that. Excuse my scribbles here. 7.5% of 100, that's easy math. Even I can do that. So that'd be $7,500 there. So if you had medical expenses of $10,000 and you have to get over that threshold of $7,500, you would still be able to deduct $2,500 of those medical expenses. So that's one part of itemized deductions. The next part is your state income tax and property tax. So we're all, generally speaking, going to have to pay some income tax to the state of California, but you might also have a home or a condo or something like that where you have to pay property tax. So those taxes are deductible on your federal return. However, they're limited to $10,000. The next one might be mortgage interest. So if you own a condo or a home, you probably borrowed money to buy the residence, and you can deduct your interest on your loan up to certain thresholds. So in today's world with a new loan, you can deduct mortgage interest on loans of $750,000 or less. If your loan exceeds that amount, you just don't get to deduct the portion of interest on the loan that's greater than $750,000. So not all is lost, but you can't deduct all of the interest on a loan exceeding $750,000. And then the last item here is charitable donations. This could be cash donations. There's a special rule this year that lets you deduct the full amount of your cash donations subject to 100% of your AGI. You could be gifting stock, things like that. When you add up all these different categories of itemized deductions, if they exceed either $12,400 or $24,800, you're probably going to want to itemize those deductions because it's larger. It's going to reduce your taxable income. So that's how that works.
Jake, question for you.
Yes.
What if you do not use up all of your deduction in one of those categories? What if you have more than you're allowed to deduct this year?
That's an interesting question. So I know that for mortgage interest and state income tax, you're just kind of out of luck there. With charitable donations, there is a special rule that allows you, if you were not able to deduct all of the charitable giving that you've done, you get to carry any excess amount forward for 5 years. The key is, generally speaking, that you'll have to be itemizing in one of those future 5 years in order to be able to use up any leftover charitable deduction that you maybe didn't get to use up in the year that you gave the gift.
Thank you.
All right. So now we're going to get to tax credits. So we're not going to get into too much detail here, but generally speaking, there are tax credits for those that are working and saving based on income limits. So depending on how much income you have, and generally speaking, relatively lower amounts of income, you could be eligible for a saver's credit or an income tax credit. If you have a family, there are tax credits for having kids, whether they're kids that you came from you, or maybe you've adopted a child. There are several types of credits associated with having children. And then finally, there's some credits related to educational expenses, and those can benefit you as well. So if you have education expenses, if you have children, if you're working and saving but you don't make a lot of money, these are things that you should be looking into because there could be an opportunity for you there. But there's a lot of nuances to how those work, so we won't get into too much detail there, but generally important to be aware of those opportunities. Okay, so now we're on the home stretch here. So how can we save money on taxes? How does this work given what we've learned so far? Well, it would seem as though the way to save money on taxes is to get married, buy a house, and have kids. A lot of the deductions and credits that we have looked at, the tax rates, the way that all works, seems to benefit people that are married, own a home, and have a kids. So those are the incentives there from the policy perspective in terms of the taxes that we pay. Moving on from that, how can you save on taxes? Well, this is the first step, and you're to be applauded for hanging in there for this half hour listening to me drone on about taxes. I know it's not the most exciting subject, but you're educating yourself, and that's really key, is making yourself aware of how taxes work and the opportunities that may be available to you. You don't necessarily need to know exactly how it works. You can always hire a professional, an accountant to work with, but at least you're smart enough to know that there could be opportunities related to yourself and your tax situation. And again, working with a professional whenever you're considering something that is a big life event or a transition. So if you're in store for a big raise, or you're getting married, or you're going to be buying a house, or you're going to be starting a business, all of those things could create opportunities for you, and it would be wise to think about the timing and the impact that might have on your financial situation. Another kind of on the not so optimistic side would be what if you lost your job, right? So now your income is much lower. Well, there still might be opportunities for you to take advantage of a situation where maybe you lost a job or you took some time off of work. And that all kinds of sums up into think and plan ahead. as you look ahead, keep these things in mind, and just have that general sense of awareness to seek help when warranted. And lastly, save and invest tax efficiently. So I mentioned at the beginning of this seminar that we're going to be doing our fifth and final installment on personal finance on investments. I'm certain they'll be covering that topic, but a little bit what we learned today is that buy and hold your investments. If you're opening up a Robinhood account and churning investments, meaning you're buying and selling things, even if you have gains, you might be losing out on a lot of what you've earned because you're turning those capital gains into short-term capital gains, and that's ordinary income, and that's taxed at your generally higher tax rates. If you're subject to the Kiddie tax, now you're paying your tax rates at your parents' tax rates, which are probably higher than they would be later on in life when you're on your own and working. So think about those things. The last couple of comments would just be participate in a 401k plan if you have the opportunity to do so. Oftentimes employers will match your contributions. That's free money. Your contributions can go in tax deferred, meaning that money is not taxed, and your employer will match that, sometimes dollar for dollar or 50 cents on the dollar. That's a pretty good rate of return, 50%, 100%. You're not going to find that, generally speaking, in any investments. So that's the final thoughts on saving on taxes. And then finally, to circle back, there are lots of resources online. Here we've mentioned two, NerdWallet and Nerd's Eye View. Apparently you're a nerd if you're into taxes, but it's interesting stuff. Who doesn't like saving and making money? These are great resources. There's Kiplinger.com. There's lots of resources out there for you to explore, and there's always the option to work with an advisor and someone to consult with you. So thank you so much for participating in this seminar or this webinar today. Hope and I enjoyed having you. Look forward to answering questions. And with that, we say thank you.
Okay, so we have a couple questions, Jake, that I'll start opening the floor for. And okay. One question is, I'm on my own for the first time and I'm going to do my taxes for the first time ever. What do I need to know to do this? What documents do I need, and what software should I be using?
Sure, that's a great question. So congratulations on being out on your own. There are a lot of different online services in terms of that would help you with your taxes. Personally, I do my own taxes and I use TurboTax. It's relatively low cost. It's pretty easy to use. It will prompt you in terms of what documents or what kind of things you may need to look at, or documents that you may need to dig up. So generally speaking, your employer is going to provide you with a tax form at the end of the year that's going to tell you, how much you made, a W-2. So those types of things. If you have an investment account, the brokerage firm or the custodian, such as Charles Schwab, for example, they'll issue a 1099 document at the end of the year. If you have a bank account or a savings account, they'll also issue, generally speaking, a 1099 if you have enough interest. So all of these organizations, they would be providing you with the documents you'll need to file your taxes, in January, February, March of the year that follows the tax year.
Follow-up question to that: are there any documents that I should be on the lookout for during the year that I should save in a tax folder or set aside somehow?
That's a good question. Some of those documents you might receive would be, I can think of off the top of my head, would be charitable gifts. So oftentimes if you make a donation, the charity will follow up with a letter, confirming your donation, and it'll state how much you gave and include all the details of your gift. I don't know, Hope, are there other documents that you can think of off the top of your head?
I think that's what comes to mind for me most frequently, most commonly for people is the charitable receipts. I think there may be some with some of the tax credits and tax in finer detail around educational expenses that you may want to keep track of as well. But in general, it's the charitable receipts that I think come in throughout the year most commonly. We also have a question on when should you go to a CPA as opposed to using TurboTax or H&R Block or some other tax prep software?
Sure, so that's a good question. If you've never done taxes before, it would be wise to seek help from someone who has. So whether that's a parent or a family member, a friend, someone that may have done taxes before, that could be someone that you reach out to. Again, using services like TurboTax could also be a good solution. And if you feel like you really want the extra attention and care, it might be worth paying the extra money to engage and work with an accountant. And I guess the good thing or the bad thing is that we have to do this every year. So over time, you'll get more experience and more familiar with taxes, how to file them, what's involved. And you might find that you're comfortable over time doing your taxes on your own or through a service like TurboTax, and you may or may not need the help of an accountant. But what I would generally recommend is if you're not confident, or even if you are confident and it's your first time, I would seek the advice of someone who can give you some additional perspective and help. Better to be safe than sorry, and pay a little bit now than pay a whole lot later because you made some mistake and did something you weren't aware of.
Another question on tax planning, and what does tax planning actually mean, and when should you do that?
Sure. So when I think of tax planning, I kind of think back to it's going to be unique for each and every person because they have their own situation and circumstances. And so how does that interplay with the tax rates and the tax regime that's in place? And tax planning to me means more than just dealing with this year. It means thinking about what your income is this year and what it might be like in future years, and developing some sort of strategy behind your goals and what you want to do with your money and how that might look different in this tax year versus future tax years. So that's kind of relates to the person and their own situation, but then there's also the tax planning that comes with tax law changes. So, what we're talking about today may look different in the future because they might change how taxes work. In fact, that happens with some frequency. So it's important to think about those things. Sometimes those things are communicated in advance and we have time to make decisions that might benefit us now or later based on those future changes. Other times these changes happen quite quickly and you need to be ready to adapt. So that's kind of how I think of tax planning. It involves your personal situation, thinking about the external factors, and thinking about more than just this year, but thinking out several years ahead, and what you may or may not be doing, and how your life may have changed.
Great. And then one more question. What is the relationship between federal taxes and state taxes, and do you need to file both?
Yes, so generally speaking, you will need to file both federal and state taxes if you have any type of income. Again, I'm not a real tax expert when it comes to situations where you may not have income or may not have taxes that are owed. But what I would say is you'll never get in trouble by filing your tax returns with the federal government and state government. It could be that they owe you money in a certain situation, so it would be wise to do both every year.
That's great. Okay. Thanks so much, Jake.
Thank you, Hope.
That's all the questions we have.
All right, great. Thanks, everyone. Have a wonderful day.
Bye-bye, everyone.